Welcome to today's Explainer. Let's just dive right in. Have you ever stopped to wonder how a seemingly tiny institution, just a few people sitting around a table in a quiet office building, can actually steer something as massive and insanely complex as an entire country's economy? I mean, we hear about it on the news literally all the time, right? But the actual mechanics behind it can feel, well, kind of like a secret language. So today, we are going to translate that language. We're going to completely demystify exactly how central banks pull the levers of the economy.
Whenever a central bank, think the Federal Reserve in the US or the European Central Bank, makes a big announcement, it's like the whole world just freezes to watch. But why? Why do Wall Street investors, local small business owners, and just everyday folks trying to buy a house all absolutely obsess over these financial news updates? Well, the answer lies in one of the most powerful forces in modern economics. And by the end of this explainer, you are going to understand exactly how it shapes your everyday life. You'll finally be able to say, okay, now I actually get this.
To get us there, here's our map for today. First, we'll look at the economic roller coaster. 2, what is monetary policy? 3, the power of interest rates. 4, accelerating and braking. 5, real-world effects. And finally, 6, myths and reality.
Okay, starting with Section 1, the economic roller coaster. Why economies naturally boom and bust.
Left to their own devices, economies definitely do not move in a straight, predictable, boring line. They're much more like roller coasters. On one side, we have these periods of rapid growth. This is when we're all spending confidently, businesses are expanding, they're hiring left and right, and investments are going up. And honestly, it feels great. But sometimes it gets a little out of hand. It can lead to high inflation, which is exactly when your money starts losing its purchasing power. Then on the other side of the tracks, we have the inevitable slowdown. People get nervous, they spend a lot less, companies totally freeze their hiring, and investments drop. Without some kind of stabilizer in place, these massive, wild swings would just create totally painful volatility for everyone.
Which brings us to Section 2. What is monetary policy? Introducing those economic stabilizers.
So what actually is it? Well, monetary policy is simply the process through which a central bank manages interest rates and the money supply to influence economic conditions. Think of the central bank as that crucial stabilizer we just talked about. And notice I use the word influence, not control. Their goal isn't to micromanage your life or command every single business decision out there. Not at all. Their goal is simply to create a backdrop of stable prices and sustainable growth, basically smoothing out the extreme highs and the extreme lows of that economic roller coaster.
Moving on to Section 3, the power of interest rates, the absolute main tool of central banks. An interest rate is at its core just the cost of borrowing money and the reward you get for saving money. I know, it sounds super basic, right? But this single lever is incredibly powerful. Central banks don't sit in a room and individually pick the exact rate for your specific credit card or your personal loan, but by changing their foundational baseline rate, they end up influencing the financial behavior of the entire economy. It essentially ripples outward, ultimately dictating the costs of our mortgages, business loans, and even how much interest you get paid just for keeping your cash in a savings account. Now, beyond interest rates, central banks do have a secondary tool, managing the money supply. You'll very often hear commentators on TV casually call this printing money, but I really want to bust that myth right here, right now. While they absolutely do inject money into the banking system, often by purchasing safe financial assets, modern money creation is almost entirely digital. They are literally just pressing buttons on a keyboard to credit bank accounts. They are not running massive Willy Wonka-style printing presses full of physical paper money down in the basement. Understanding this digital distinction really helps separate the reality from the popular financial myths we hear all the time.
Let's look at how this plays out in Section 4, accelerating and braking, steering the economic engine.
I want you to think of the economy as a car, and money as the fuel keeping it going. When the economy is looking weak or we're in a recession, the central bank uses what's called expansionary policy. Basically, they press the accelerator. They lower interest rates, which makes borrowing cheaper. Imagine a local business wanting to build a brand new factory. If the bank loan costs 12%, they might just scrap the whole idea. Way too expensive. But if the central bank lowers rates so that exact same loan now costs only 5%, suddenly that factory gets built. New workers are hired and economic growth is stimulated. But what happens if inflation is running way too high and prices are getting completely out of control? Well, the central bank switches to contractionary policy. They apply the brakes. They raise rates, which makes borrowing much more expensive, and that naturally cools down spending and slows inflation.
All right, Section 5, Real-World Effects. Let's trace this all the way from the bank to your wallet.
Economists actually have a fancy name for this chain reaction. They call it the transmission mechanism. A lot of beginners assume that when a central bank raises rates on a Tuesday, the entire economy just slows down by Wednesday, but that is completely not true. Step 1 is the actual decision itself. Then Step 2, commercial banks have to adjust their own rates. Step 3, everyday consumers and businesses slowly start to change their borrowing and spending habits. Moving to Step 4, overall business activity finally starts to shift. And then finally, at Step 5, we actually see the real changes in employment and inflation. This entire sequence, it can take months or literally even years to fully play out. To see just how profound this shift can be, just take a look at the housing market. Let's say you're buying a home. A mortgage rate of 4% creates a drastically different monthly payment than a mortgage rate of 8%. That gap right there, that might be the single determining factor in whether a family can actually afford a home or not. When rates fall down to 4%, affordability improves and housing demand totally skyrockets. But when they rise to 8%, way fewer people qualify for loans and the housing market naturally cools off. It's a direct, profound impact on our daily lives.
And by the way, this also perfectly explains why the stock market goes absolutely crazy during a central bank announcement. Because investors know all about that delay we just discussed, they are always trying to look into the future. They know for a fact that lower rates usually mean cheaper borrowing and higher corporate profits down the road, while higher rates might squeeze those future profits. So they react instantly to adjust their expectations for the future, all based on today's interest rate announcement.
Let's wrap up with Section 6, Myths and Reality, clearing up some common misunderstandings. Let's just knock these down one by one. Myth number 1, lower rates are always a good thing. The truth, if rates stay way too low for way too long, they can overheat the economy and cause rampant inflation. Okay, myth 2, higher rates are always bad. Truth, while they definitely make borrowing a lot more painful, they essentially protect your purchasing power by taming that inflation. Myth 3, central banks control everything. Truth, they only influence conditions. They certainly cannot control consumer confidence or the latest technology or massive global supply chains. And finally, myth 4, policy works instantly. Truth, as we literally just saw with the transmission mechanism, it requires a lot of patience.
So tying this whole thing together, even if you absolutely never tune into the financial news or read a dense economic report, monetary policy is actively shaping your reality. It completely dictates the returns on your savings account, the cost of your car loans, the health of the job market you're trying to apply in, and yes, even the prices you pay at the grocery store. It really is the invisible current flowing beneath our entire financial system.
Now that you truly understand how this massive economic machine is steered, how the accelerator and the brakes actually work, I want to leave you with one final thought. When you see the next big headline announcing a change in interest rates, how is that specific change going to affect your own financial decisions? How will it impact your savings or your future big purchases? Really think about it. Thank you so much for joining me for this explainer, and I genuinely hope you leave feeling a whole lot smarter than when you started.